Welcome to the CandleStick AI Market Lab. I'm Jake, your market researcher. Let's get into today's tape. A preliminary US-Iran ceasefire just hit the wire, and it instantly sent Nasdaq futures surging 2%. Since late February, this war has been an absolute wrecking ball for risk assets. We saw 1/5 of global oil flows through the Strait of Hormuz get choked off. That supply shock sent WTI crude rocketing past $92 a barrel, and it dragged May CPI inflation up to a brutal 4.2%. Gasoline prices alone jumped 40%. That kind of inflation forced the market to price in a nightmare scenario. We're talking sticky inflation, 0 Fed rate cuts in 2026, and a massive tech sell-off. Gold even spiked past $4,100 an ounce on pure panic. But today's peace deal completely flipped the script. The VIX collapsed, safe haven premiums vanished, and equity futures exploded higher across the board. So who actually wins and loses in a sudden de-escalation? Let's start with the defense sector. Names like Lockheed Martin and Raytheon were the rare bright spots during the fighting. Now, they're looking incredibly volatile. The ceasefire instantly reduces the urgency for a prolonged military buildup, pulling the rug out from under that trade. Then you've got energy. You'd think Exxon and Chevron would have crushed it with oil near $100, right?
Wrong. They actually fell during the conflict because Wall Street was terrified of demand destruction. And with crude tumbling below $84 on the ceasefire news, their earnings outlook is just a volatile mess right now. But here's the real story. Big tech got absolutely hammered by rate hike fears over the last 4 months. With the peace deal easing those inflation terrors, the relief rally is massive. NVDA is looking incredibly bullish right now. Same goes for Tesla. It's a high beta growth stock, so any drop in interest rate panic is pure rocket fuel for shares. But hold that thought, because this relief rally has a massive catch. The macro scars from this war are deep. Even with the Strait of Hormuz reopening, Enverus is projecting Brent crude will stay above $100 through 2027. Why? Because the war created a brutal inventory deficit. Add in a 29% slump in Chinese crude imports, and the energy market is still fundamentally broken. That means cost-push inflation isn't dead, and the Fed is still locked in a holding pattern. If inflation stays sticky, we might even see rate hikes in 2027. So enjoy the risk-on phase, but brace for a long, uneven normalization. This is exactly the kind of event-driven dislocation where our quant screens cut through the noise. Head over to www.candlestick.trade for the underlying data, quant screens, and live signals. Hit that like button and subscribe so you never miss a deep dive. See you in the next one.